Now that we've explained kind of the concept behind making money like the banks, let's dive into specifically how you're able to implement it, what type of products to use, and how it actually works. Fair enough? So we talk about insurance companies and that you create this banking relationship with insurance companies, but what specifically or what specific products can we do this with? Well, specifically, we're referring to life insurance. There's certain types of life insurance that you can create this banking concept with, right? Where you get to keep your money in the account, continuing to grow while you're able to utilize it in other ways. So let's talk about life insurance for just a second. Now, there's three basic types of life insurance, and if this was the cost curve, age 0 to 100, you can see the cost gets more expensive over time. Well, the first type of life insurance is what we call term. It's the most popular, and what most people have, and it's basically you start whatever age you're at on the curve, and you get a fixed cost for a certain number of years. So there is an ending point to that coverage, which is why some people like to utilize whole life. Whole life is named appropriately. It covers you for your whole life, right? And it has a fixed cost as well, but compared to term, it's quite a bit more expensive. Okay, whereas there's a hybrid in the middle called universal. Okay, it's a hybrid because it has more of a term-like cost, but also covers you for your whole life. Okay, as a result, it does have somewhat of an increase in cost over time, but not this exponential increase like you see on the curve. Okay, and so if we were to pay $100 in premium to these types of policies, now this is not 100% accurate, but it's just to illustrate a point that in a whole life policy, maybe 80 of your 100 goes towards paying for that life insurance, that death benefit that would pass on to your family if you passed away. And then the 20 that's left, that's where the savings is. That's what you can build up. That's what it's gonna grow and you can have access to in this kind of banking concept. Now that 20 is gonna grow at maybe 3 to 6%. Whereas with universal, because the cost is structured differently, you might only pay $30 for that cost, which leaves 70 to go towards the savings side. So a lot more of your money potentially goes towards the savings side. Whereas with term, you might pay the least of all. You're going to pay the least of all for your coverage, but the catch is there's no savings associated with it, right? And this is why you find some people that talk about buying term and investing the difference, because the idea is I pay the least amount possible for my insurance. I have my $80 that's left. If I go invested that, say in the market, I'm probably historically going to get better than 3 to 6%. So more money invested, better rate of return. Why isn't it a better deal? Right? That's kind of the idea. Well, if I add the word index in front of universal, I can actually get that market-based return, but with some additional perks by combining it with the insurance company. Because when I'm referring to indexed, I'm talking about market indexes. Let's say the S&P 500, the Dow Jones, the Nasdaq. These are what we would call market indexes. Okay, so I can get the growth of the market with the additional perk, though, that it's actually guaranteed against loss. Okay, so I can get the growth without the risk of loss. Now I'm going to show you a graph here. Now the products that we deal with, they don't have caps necessarily, but I'm going to show you that even with a cap on the upside, okay, meaning that you're not getting 100%, anything that's if the index or market grew above 14.5, you're not getting that. So you're foregoing the upside. But the fact that you never lost anything makes a huge difference, okay? And so if we look at the market over the last 20 plus years, the green years are all the down years, and there's only 7 of them. So there's only 7 down years. The rest are up, right? And all these remaining up years, many of them are well over 10%. So great returns in the up years, very few down years, okay? And everything's good. So 100 grand invested in that time frame turns into 405. We 4 times our money. Everyone's happy. No problems. Okay. But what if we could eliminate the losses? Okay. So instead of, say, losing almost 40% in 2008, right? What if we just stayed at 0? We didn't go backwards at all. But then instead of in 2009 getting 27, we only got 14.5 because that was the cap. Right? Most of the time, these in the market, you need these big returns after the down years just to get back to where you're at. And we can see that in this graph. Okay. And so that same 100 grand though turns into 740. Now you almost seven and half times your money over the same market, in the same market over the same period of time. And the only real difference is, like I said, you don't have to recover. So instead of losing here, right, we stayed flat where we're at and it started growing from here. Okay, then when it lost again, instead of having to take years to recover back, it was already growing with that growth, but it's up here instead because you don't have to worry about recovering from the losses. Okay. And so to recap here, what we have is you have this banking concept where I can keep my money in the account, continuing to grow and compound while I use it in other ways. And if the account that the money is sitting in is something like this that we're talking about here, where I can get market growth with no loss, man, now we have something special, something unique. Okay. But this isn't even the most magical part, so to speak. It's really the ability to take a loan versus a withdrawal out of your account that makes all the difference in the world. Because if we took a traditional investment and we looked at it from a retirement perspective, someone saved 500 a month for 40 years for at 7% for 30 years, it'd grow to 566. Now let's say they're retired, they want 67,000 as an income for the year. Okay, depending on taxes, that money's going to be gone in 7 to 13 years. Okay. Whereas with this index universal life, same money in, but let's say it only grows to 523 because a portion of my 500 is paying for a life insurance policy that I'm not paying for over here. Okay? But here's the thing. It's not how much you accumulate, it's how much you get to spend that makes the difference, right? Because aren't we saving and investing today to spend it at some point? Okay, so if the end goal is to spend the money, we want the plan that helps us spend the most money, even if it means that it accumulates less, right? Because what we're going to show you here is that being able to take a $67,000 loan against your account versus a withdrawal out of your account, the money ends up lasting the rest of my life tax-free. Okay. Now you might be thinking, how in the world does that happen? And that doesn't make any sense. Well, let's break that down a little bit. Don't go get overwhelmed by these numbers, but I'm going to point out a few things. So if we look at a traditional investment, it grew to that 566, but when we take a 67,000 withdrawal, our account value goes down. Even with interest added back in, we don't get back to our 566. We're at 539. So even if you have a 7% return and you're getting 7%, the same interest rate every year, you're making less and less interest because 7% on 539 is less than 566 and 510 is less than 539, etc. So each year I'm making less and less interest in dollars, even though my interest rate is exactly the same. Okay? And so that withdrawal kills the account and it disappears in that around that 13th year. Versus this insurance policy where I have 523, but because I took a loan against it, it's not my money is not actually coming out of my account. It's actually the insurance company's money. And so my account then goes up to 563. It goes up to 563, 607, 654, 705. It continues to grow and get larger each year, even though I'm taking these loans. Let's think of this like a home and a mortgage. Okay? The value of my home has nothing to do with my mortgage. The mortgage only determines how much I get back if I was to sell it. Okay? So the value of my home, so to speak, is my account value, and it continues to grow regardless of the mortgage or this line of credit that I'm accruing against it. Okay? And so a lot of people ask at this point, well, it's a loan, so when does it get paid off? How does that work? Am I going to be in debt? Well, no, in the sense that in the traditional sense, what happens is let's say you were to pass away. All right, in this at age 80. Let's say you pass away at age 80. Your account value now has grown to 1.6 million, But you have this spendable cash column. This is your equity, the difference between your mortgage and the value of your home, so to kind of analogy here. So basically what we're saying is that we have a 1.5-ish million dollar mortgage, and in my account value or home is worth 1.6. So what happens, I pass away, and the 1.6 pays off the 1.5, and the 160 that it's showing here is what is added to your death benefit, and that all passes on to the family tax-free, income tax-free, right? Now, an interesting thing also is that there's this crossover point where your account value, in this case, it's at age 86, your account value starts to generate more interest than you can accrue with your mortgage. And because it hits this low, your equity hits a low of 111, but then it goes up to 113, 18. If I extended this out, it would continue to increase, which is why you're able to take this income for the rest of your life. Your account value, the value of your home, grows at a faster rate than the mortgage, so to speak, can catch up with it, and it lasts the rest of your life tax-free, right? Now, that's a lot to kind of digest, and there's probably questions that come up. Feel free to respond in the video, in the comments of questions, and we can address them. But to kind of wrap this up, going back to this idea that we started with this financial house in the previous video, is that this strong foundation is that this gives you market-based returns, guarantees against loss, don't have to pay taxes as it grows, don't have to pay tax when you use it. It's liquid because there aren't age stipulations and penalties associated with it. And then there's this life insurance component that if the worst case scenario happens, money comes back into this house to keep it going and strong and keep that foundation solid, right? So is this the end-all be-all thing anyone should ever invest in? No, there's other things you can do. But hopefully you can see, as I mentioned in the previous video, hopefully you can see that this is a foundation you can build upon that's strong, solid. It's not going anywhere. It's protected. And there's a fail-safe that if something bad happens, money is reimbursed or comes back into the house to keep it going. I mean, what better foundation to build upon, right? Let us know your thoughts in the comments.